Ladies and gentlemen, today we turn our attention to Iraq, a nation whose history, politics, and economy have been intertwined with the fate of its national currency, the Iraqi dinar. On this day, August 20th, 2025, the story of the dinar takes yet another dramatic turn. Markets across Baghdad, Basra, Erbil, and beyond are buzzing with activity as the value of the US dollar surges against the local currency. In the narrow alleys of the Qarada money exchange markets, shop owners are calling out new rates almost by the minute. Earlier in the day, 100 US dollars could fetch around 142,250 dinars. Just hours later, that same $100 bill commands nearly 144,000. In Erbil, the numbers move in lockstep, shifting between 1,425 and 1,427 dinars to the dollar. For ordinary Iraqis, these are not just abstract figures on a financial screen. They mean higher costs at the market, more dinars needed to buy imported goods, and a growing sense of uncertainty about the future. For traders and speculators, the sudden surge is both an opportunity and a warning. And for policymakers in Baghdad, it's a challenge that strikes at the heart of economic stability. But why is this happening now? Why, in the middle of August 2025, is the US dollar suddenly pushing upward against the dinar with such force? To answer this, we have to look at a web of interconnected factors, global, regional, and domestic. The Central Bank of Iraq had long held the official rate of the dinar at 1,300 to the dollar, a figure revised back in early 2023 to stabilize markets after years of turbulence. Yet, on the streets, reality often tells a different story. The gap between the official rate and the market rate has widened, especially during times of political strain, oil market volatility, or shifts in U.S. monetary policy. And today, as we speak, that gap has turned into a glaring spotlight on Iraq's economic vulnerabilities. Imagine the scene for a moment. A young man in Baghdad walks into an exchange shop, clutching a handful of dinars. He wants to buy dollars to send to a cousin studying abroad. The clerk looks at the digital board and shakes his head. "The price has gone up again," he says. The young man sighs, pulls out more dinars, and completes the transaction. Multiply this moment by thousands, and you begin to sense the ripple effect. Across the country, every family, every business that deals in imports, every trader in the bustling souks feels the pressure. What we are witnessing today is more than just a number changing on a screen. It is the manifestation of Iraq's deep reliance on the dollar, the fragility of its financial systems, and the tug-of-war between local policy and global forces. The rise of the dollar today is not accidental. It is shaped by several converging factors. First, let us consider the broader global context. The United States dollar, driven by the Federal Reserve's tight monetary stance and strong U.S. economic performance, has been gaining ground against many emerging market currencies. When the world's largest economy raises interest rates, capital tends to flow back into dollar-denominated assets. Investors worldwide seek the safety and profitability of U.S. treasuries, bonds, and markets. For Iraq, whose currency does not float freely and whose economy is highly dollarized, this means that every upward tick in the dollar puts pressure on the dinar. The surge we are seeing today is, in part, a reflection of these global monetary winds blowing through Baghdad's currency exchanges. Yet, external forces alone do not tell the full story. Iraq's domestic landscape adds its own layers of complexity. The Central Bank of Iraq has recently reported a decline in the volume of currency issued, a measure intended to reduce inflationary pressures. On the surface, this is good policy. By limiting the circulation of dinars, the central bank can help prevent runaway inflation. However, the unintended consequence is a squeeze in liquidity. With fewer dinars circulating, businesses and individuals scramble to secure US dollars, which are seen as more stable and internationally accepted. This scramble intensifies demand, pushing the dollar's value up even further against the dinar. Add to that the ongoing struggles with smuggling, sanctions, and informal currency channels that bypass official controls, and you have the perfect recipe for today's surge. At the same time, Iraq's gold reserves have been growing steadily, reaching the equivalent of nearly 23 trillion dinars, or about $17 billion, in mid-2025. On paper, This strengthens Iraq's ability to defend its currency. Gold serves as a hedge, a store of value that gives confidence to both domestic and international markets. But gold in the vaults does not automatically translate into stability in the streets. Unless those reserves are actively deployed to intervene in the market, the average Iraqi will still feel the sting of a surging dollar at the exchange counter. This contradiction between strong reserves on paper and weak dinar performance in reality underscores the challenges facing policymakers. And then, there is oil, the lifeblood of Iraq's economy. Oil revenues account for more than 90% of government income, and fluctuations in global oil prices directly impact Iraq's ability to stabilize its currency. When oil prices are high, the flow of dollars into Iraq strengthens the central bank's hand. But when oil prices slip or exports are disrupted by geopolitical tensions, the supply of dollars tightens. This week, oil markets have been jittery, with prices swinging in response to production cuts and global demand uncertainties. For Iraq, any dip in revenues means fewer dollars entering the system, adding more fuel to the surge we see today. Now that we've unpacked the differences between Baghdad and Erbil's dollar markets today, let's dive deeper into why this divergence matters, not just for traders and businesses, but for Iraq's future economic direction. Because when exchange rates split between regions, it signals something much bigger: the uneven heartbeat of an economy struggling to unify. Let's go back to Baghdad. Imagine walking through Qarada, one of the capital's busiest commercial districts. Shopkeepers are keeping a close eye on the day's dollar rate, because every tiny shift in the price can decide whether they make a profit or take a loss. Importers of food, electronics, and clothing depend on dollars to bring in their goods. If the dollar jumps even by a few dinars, the extra cost gets passed straight to the consumer. This is why people in Baghdad often feel the impact of fluctuations more quickly and more painfully. Inflation here is not just a statistic. It's the difference between affording groceries or cutting back on meals. Now contrast that with Erbil. In the city's bustling markets, you still see price increases, but they are slightly cushioned. Why? Because Erbil benefits from having multiple channels of trade. Its proximity to Turkey means goods flow in with a different pricing dynamic than those arriving through southern ports controlled by Baghdad. This creates a kind of regional buffer. Even when Baghdad is under pressure, Erbil often enjoys more stability, thanks to its semi-autonomous government and diversified supply routes. But don't mistake that for immunity. If the dinar weakens nationwide, Erbil feels it too, just not always at the same speed or severity. The second big point is political trust. In Baghdad, the central bank of Iraq directly enforces its monetary policies. But in Erbil, while those policies still apply, the region has its own financial habits, its own networks, and its own way of managing dollar demand. When people in Erbil see Baghdad struggling with shortages or restrictions, they sometimes rely more on local mechanisms, strengthening the sense that Erbil operates slightly apart. That's why rates diverge, not because the dinar is officially different, but because the way people access dollars is. But here's where things get really interesting: the psychology of the market. Exchange rates are not just about supply and demand. They're also about confidence. If people in Baghdad believe the dollar is going to rise, they rush to buy, which drives it up even faster. In Erbil, where financial flows are less tense and more diversified, that panic often doesn't spread as quickly. This is why Baghdad tends to lead in volatility while Erbil trails with smaller adjustments. The psychology of fear and speculation plays a powerful role in shaping daily rates. So what does this all mean for Iraq's broader economy? The short answer is division. When two major cities operate on slightly different currency realities, it sends a message to investors and international partners that Iraq's markets are not fully unified. That weakens confidence in the system, makes foreign companies more cautious, and complicates the central bank's efforts to create a single, strong financial identity for the country. Let's not forget the bigger picture. The official rate is still 1,300 dinars per dollar. But if Baghdad is trading at 1,431 and Erbil at 1,425, that's a difference of more than 100 dinars from the official line. That gap is what economists call the parallel market rate. And the wider the gap between the official and the parallel rate, the more ordinary Iraqis lose faith in the system. They start to see the official rate as artificial, something only banks and elites can access, while everyday people are forced to live with the harsher reality of street prices. Now, could this divergence between Baghdad and Erbil eventually trigger reform? Possibly. The Central Bank of Iraq is watching closely, and history shows that when the pressure between official and street rates becomes too wide, governments are forced to act. Sometimes that means cracking down harder on smuggling and unofficial networks. Sometimes it means adjusting the official rate itself to reflect reality. And sometimes, though rarely, it means preparing for more ambitious moves like a gradual revaluation or restructuring of the currency. For Iraqis holding dinars, this is the heart of the matter. Will today's differences between Baghdad and Erbil be remembered as just another small fluctuation, or as part of a larger trend pointing to systemic change? That depends on what happens in the coming weeks. If Baghdad stabilizes, the story fades. But if the capital's rate continues to weaken while Erbil holds steady, it could deepen the sense of imbalance between Iraq's two economic centers. That imbalance is not just financial. It's political, social, and symbolic. Let's imagine a possible scenario. Suppose Baghdad's rate hits 1,450 while Erbil stays closer to 1,420. Traders will start to arbitrage. That means they'll look for ways to exploit the gap, buying dollars where they're cheaper and selling where they're more expensive. This could lead to flows of currency moving across regions, fueling both speculation and tension. The central bank hates this kind of gap because it loses control. And the more people play the difference between Baghdad and Erbil, the harder it is for the bank to enforce a single, unified policy. At the same time, ordinary Iraqis will adjust in their own way. Families may start traveling to Erbil to buy certain goods if prices are better there. Businesses might shift operations north to escape Baghdad's volatility. Over time, that strengthens Erbil's role as a financial hub and weakens Baghdad's. This is why the stakes are so high. A few dinars difference may not sound like much, but multiplied across millions of transactions, it shapes the very balance of power inside Iraq's economy. So where does this leave us tonight? The story of Baghdad versus Erbil is not just about exchange rates. It's about identity, stability, and the future of Iraq's financial independence. It's about how one country, united by a single currency, can still live with two economic realities. And it's about the choices the central bank and government must make if they want to close that gap and restore trust. In the end, today's differences in the dollar rate between Baghdad and Erbil remind us of one simple truth. Currencies are not just numbers on a screen. They are reflections of trust, stability, and the collective confidence of a nation's people. Until Iraq finds a way to unify its markets, those differences will continue to tell the story of a country searching for balance in a world where the dollar still holds all the power.